I have come here to chew bubblegum and kick ass, and I'm all out of bubblegum.
This is the Virtual Real Estate Investor Podcast with Vincent Polisi. Buckle your seatbelt and prepare to learn how to legally make six figures investing in real estate with no money, no credit check, and nothing but a computer and internet connection. Learn how you too can begin generating buyers and sellers for free today. And why you're only 2 calls away from making a $10,000 or more payday while never leaving the comfort of your home. And now, your host, the virtual real estate investor, Vincent Polisi.
All right, everybody, this comes up time and time again, and what we're talking about today is how to properly structure homeowners insurance on an owner finance deal. Okay, this comes up literally every single week, over and over again, and it's almost always taught wrong. Okay, so I'm going to show you exactly how to do this. So if you're doing an owner finance, we'll cover a couple of different scenarios here. If you're doing an owner finance sandwich, okay, what does that mean? That means that, as an example, I go out there and I buy a property on some variant of owner finance, whether it's a contract for deed, a land contract, installment sales contract, subject to with a wrap, whatever, any variant of an owner finance installment sales agreement, any of those things. Basically what's happening is I'm buying the property from the seller, and then I'm going to turn around and I'm going to sell it to another buyer. Okay, so this is called a retail sandwich in most cases, because that's predominantly what we deal with is retail. Nonetheless, so in that arena, here's how it's done. Okay, and people get this confused time and time again. So somebody was talking about this the other day, and they were talking about having a landlord policy and all this other stuff, and all of that is totally incorrect. So there's only one policy on the property that's necessary. Okay, and that policy is going to be the policy of the buyer. Okay, and by buyer, I'm not talking about you. I'm talking about the person buying the property from you. Okay, and what they are going to get is they are going to get a standard. It's called an HOI, homeowners insurance policy. Okay, just a normal vanilla homeowners insurance policy with them as the owner occupant. Now, here's what where the confusion comes in is off of what's called the deck page. And if you don't know what deck page stands for, it stands for declarations page. Okay, that's what we call it, deck page. And how the deck page is set up. So let's talk about that. We'll talk about who the entities are real quick and how to set it up correctly. So on the deck page, you're going to have the insured. You're going to have mortgagees, if there are mortgages, which in this case there are because we're doing owner finance sandwich. Okay, you're going to have additional insured, and you're going to have an ability to assign rights via what's called ISAOA ATIMA. What that stands for those of you who have never seen that before, is it's successors and or assigns as their interest may appear. Okay? All right, so deck page. Here's how it plays out. It's going to list the mortgage company. If there's let's say the person you're buying from has a mortgage with Bank of America. So it's going to list the mortgage lender as the mortgagee. Okay? Under what's called the mortgagee clause. Done correctly, it's going to list the seller that you're buying from he also gets listed on the mortgagee clause. Why? As a mortgagee. Why? Anybody know? Because he's holding the paper for you. He actually technically is a mortgage holder at that point, because you have some variant of owner finance mortgage with him. Okay, so he's also listed as a mortgagee, right? You also get listed as a mortgagee because you are carrying paper now for the buyer. So we have 3 mortgagees on here. We have there may be more if they have a first and a second mortgage with 2 different lenders, but any underlying notes would be listed on the mortgagee clause. Okay. The seller would be listed on the mortgagee clause, and you would be listed on the mortgagee clause. And basically what the mortgagee clause is there for is to show the homeowner's insurance company the succession of people that need to get paid first before any proceeds are distributed to the homeowner. Does that make sense? Hopefully that makes sense. Okay. Now, let's get to the next part. We're also going to list, it's done correctly, list the seller as additional, it's called additional insured. Okay. Also going to list you as additional insured. Why are we doing this? Anybody know? Anybody know why we're doing this in addition to being on the mortgagee clause? Because the mortgage being listed as a mortgagee on the mortgagee clause, you're already protected. You've already got insurance. You're already in whatever position you're in, second or third position for a payout in the event the house burns to the ground or God forbid something else happens. Does anybody know why you also want to be listed as additional insured and why you want the seller listed as additional insured? No? Nobody? All right. Here's why. Very simple. In the event of an insurance default, meaning the homeowner stops, the buyer, your buyer stops paying the homeowner's insurance, the additional insured gets notified. Okay. And the reason they get notified is because there's now risk. There's significant risk of the property not being insured. So the mortgagees are going to get notified, but you want to make sure that you're listed as additional insured so that you also get notified. And at that point, once you've got that notification, what you can do is, and you want to do this obviously before the mortgage lenders do it, is you can force place insurance to ensure that there is no gap in coverage. All right. So if you walk back through that process, so the guy in the house stops paying, for whatever reason, he forgot to pay it, just decided not to pay it, whatever. And then now there's a potential for what's called a gap in the insurance. And once that gap happens, you got a problem because the property is not insured. Okay. Does that make sense? And you want to make sure that you are insured. So you're going to get a notice in the mail. And now you have the ability, hey, I've got notified Mr. Buyer. Hey, what's going on? The insurance company's telling me that there's a potential for a gap in your insurance, in the insurance. We need to get that corrected and paid for and blah, 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 whatever it is. Or if they're non-responsive or combative, then at that point in time, you can place your own policy on the property. Okay. Does that make sense? And then over and above that, you're going to have on the deck page the actual insured, which is your buyer. Okay. Now, if we go back up here and we're talking about ISAOA, ATIMA, that goes under on all the mortgagee clauses. Why is that? That's because in the event of a transfer of servicing, they want to make sure that the insurance carries forward with it, with all rights to the insurance, et cetera, blah, 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 to whoever the assignee is. All right. And that's it. So let's review this real quick, because I know this gets really confusing for a lot of people. You have on the deck page, you're going to have the insured, you're going to have mortgagees, and then you're going to have additional insured, and then you're also going to have your assignment clause. Okay. So the mortgage lender, any and all mortgage lenders, and I'm talking about institutional mortgage lenders, Bank of America, Wells Fargo, whoever, they're going to be listed under the mortgagee clause. Okay. And people talk about all the time about concern over the due on sale clause and all that stuff. And doesn't a change of insurance notify and trigger them of all of those? Yeah, of course it does. They don't care. All they care about on the insurance, I've never once had any problem ever obtaining an insurance policy utilizing this correct method of doing it, because all the lender cares about is, are they covered, number one? And you guys, if you don't know what they're looking to be covered for, I'll cover that here in a second. Are they covered, and are they in the right position of coverage? Meaning the first lien holder, the first mortgage holder, would be in the first position, second mortgage holder, second position, and on down the line before any proceeds drip down to the homeowner. Okay, they want to make sure that they got their hand out first for the money, since they've got the $300,000 note hanging out there that hasn't been paid for a house that's no longer there. Okay, so we've got institutional lenders as mortgagees. We have the seller and yourself as mortgagees. And then we have you and the seller also listed as additional insured to ensure that you get notified in the event of any potential gap. And then you have your buyer listed as the insured. Now, what are they going to get insurance for? Insurance amounts, for those of you guys who don't know, okay, it's going to be called, it's either the amount of the sales price, which most of the time an insurance company is not going to give you, and I'll explain why in a second, or guaranteed, what's called guaranteed replacement value. Okay, and that's typically what you're going to get most of the time, is guaranteed replacement value. Why will they not normally give you the sales price? So in other words, you sell a property for $400,000 on contract. Why can't you get it insured for $400,000? Because let's say you have an appraisal says it's worth $400,000. Very, very simple reason. The reason for that is because the house can burn to the ground, but the lot is still there, and the lot has value, and that value is incorporated into the appraised value and the sales price. And since the lot can't be destroyed theoretically, they typically will give you what's called guaranteed replacement value for the insurance amount. And what that means is if the house burns to the ground, they will guarantee whatever the cost is to rebuild it back. Okay, and that's all you need. That's all you need. Very, very simple. Okay, where a lot of people go wrong in these things is they make mistakes that then lead them to essentially commit all different types of insurance fraud, whether knowingly or unknowingly, because they're concerned about triggering the due on sale clause, which, it's not going to happen. We've never had it happen once. Don't know anybody that's ever had it happen. Can't find anybody that's ever had it happen. Not saying that it can't happen. We did a whole webinar on that about due on sale, but nonetheless, done correctly, all they care about is, number one, are their payments being made on time, and number two, are they insured? That's all they care about. Okay, they're not in the real estate business. They're in the collecting interest payments business, and they want to make sure that the underlying collateral is protected, and it's protected in a way that they get paid first in the event of any type of a mishap. But very, very simple. Now, you do not need or want a landlord policy on a sandwich deal like this. And the reason for that is because it's not going to be of any use to you. You're not a landlord, okay? You guys, hopefully you understand what I'm saying. You're not a landlord on the sandwich transaction, okay? And to try to get a policy as a landlord, it's fraud, because you've sold the property. Now you've sold it, whether on some type of installment sales contract or whatever, and you're classified as a seller. You then take the place of lender. You're no longer the seller, and now you're a lender, and you're not a landlord. Okay, so you don't need a landlord policy. Could you get a structural policy on the property? Of course you could, But why? What would be the point? The buyer is paying for the homeowner's insurance that covers you. That's why you're listed as a mortgagee and also why you're listed as additional insured. Buyer's paying for that, okay? Now, I'll tell you what, I want to give you guys a bonus here real quick that took us a while to vet years ago with an insurance agent. And yeah, we vetted the whole thing and got it all in writing at the time that we did this. So here's a little extra bonus for you real quick, and then we can we'll end this. If you have any questions, now's the time to ask. So one of the big problems that people have when they're out there and they're doing, if they're trying to do lease options or they're trying to do owner finance deals or subject to or whatever, one of the biggest problems they have is seller asking for a security deposit, right? Obviously, most of them want a down payment, but in the event that you've gotten past all that, sometimes they'll want a security deposit because they have legitimate concerns about, the property being returned to them in a condition that's unacceptable. I've had this brought up time and time again. I don't pay security deposits. Number one, I'm not renting the property. I'm buying the property from you, so there is no security deposit. And number two, guess what? You guys ready? Here comes a little golden nugget for you. Doing what I just showed you how to do with the homeowner's insurance policy, you can immediately end this objection of them asking for a security deposit or requiring a security deposit. And here's why. The homeowner's insurance policy is going to cover everything, okay? And infinitely more than the standard 1 month's rental amount, okay? So let me give you this scenario. So let's just say, and unfortunately, these things happen sometimes, but you get a buyer, you sold a property to a buyer on contract. They're in the property 3, 6, 9, 12, 18, 24 months. Hell, it could be like the one in San Diego, could be in there 5 years, whatever. All of a sudden, they default and stop paying, and they get all mad and they tear the house apart. Okay, they do all the crazy stuff that people do, like pour purple paint on the carpet and take sledgehammers to the walls and do all the crazy stuff people do when they're going through foreclosure and all that. Let's just say that happens and they totally wreck the house. Okay. Well, we all know, anybody that's ever landlorded property before knows that anytime that you have a scenario where there's damage to a property, the security deposit never covers it. It's always way worse than whatever the security deposit amount is. It always has been in my experience. Maybe somebody else had a different experience, but it's always way more than that. In this scenario here, what happens is if, let's say, I'm in the sandwich. I bought the property from the seller. I've sold it to the buyer. Buyer stops paying, tears the house apart. We go out there. I'm not going to go out there, but somebody out there, they send me photographs and it's all destroyed. Well, guess what we're going to do? We're going to file a claim against their homeowner's policy for vandalism. Okay? So it doesn't cost me anything. And I've got greater protection than I would if I had a 1 month security deposit. The seller of the property also obviously is covered under this, right? Because it's just a chain all the way down the chain. And what's going to happen? Well, the claims adjuster comes out and hands checks, and the property gets put back in the very condition that it was in before that person tore it apart. Okay? Now, infinitely better than a security deposit. Okay? Because you're going to have you've got a lot more coverage if they do something. I mean, standard security deposit is 1 month typically in most places. So if you had $2,500 for that and you got $50,000 worth of damage, well, you're upside down $47,500. Under this scenario, with the insurance done correctly, you're out nothing. Okay. And it doesn't go against your policy. So you have higher premiums. It's going against the insured's policy. So unbelievable win-win. Okay. And the way that you guys can get away from and around the requirement by a seller of a security deposit so you can get your deal done. Okay. That right there was worth all the money you paid for this webinar, which was nothing. But anyway, worth way more than that, because I can't tell you how many deals I've been able to do because I can give them the comfort that they're looking for and the peace of mind. And it's infinitely better than what they thought they were going to get, which was essentially 1 month's rent, where they know, like I do, that when somebody destroys a property, it's for way more than the 1 month's rent. So, all right, guys, listen, I appreciate that. Hope you guys had a great time. Hope you learned something. If you did, likes, thumbs up, all that stuff, leave a nice comment, whatever. But other than that, unless anybody has any questions, we are going to move on and go make some money. You guys have a great day. It's my pleasure, Damon. Hopefully that helped you. Let's go make some money, man. Thank you, Gerard. That's very kind of you.
Thank you for listening to the Virtual Real Estate Investor Podcast with Vincent Polisi. If you found any value in this podcast, please use our Give to Get method and take a moment to give us a 5-star rating in iTunes and your favorite podcast service so we can keep giving you excellent episodes of real content you can use to profit today.